Good evening and welcome back to Be Rich. I'm back from Oman. My close friend for last 35 years and one of my closest friends is here with me and he came with me to Oman. His name is Dilip and he runs a startup in Bangalore called Trek, along with a couple of more of my friends, Subbu and Shamil. So three of them together run Trek. It's a startup company. They have raised money from venture capitals and it's one of those companies which is profitable. It's not loss making company, it's a profit making startup and therefore they don't need to raise any more money. Another beautiful thing about this company is they have more than 100 people working and all of them work from home. So that is his current avatar and he used to be in IT sector in corporates in the banking and finance space. But that is of that apart. Me and Dilip are very close friends and who have constantly exchanged investment ideas. And why did I bring Dilip today is because today I wanted to talk about options because there has been lot of action on options in the space where I'm talking about. Lot of retail investors have burnt their hands writing options. What is writing of options? First, we have to understand that. And we have had several celebrity influencers misleading people as if it's easy money in the plucking. So, first, I will tell you what is an option. An option is a right to purchase or sell a stock or an underlying index in the stock market. But options did not start with stocks, it started primarily in commodities at the Chicago exchange, mercantile exchange. So it is an American invention which has moved to stock market and has come to India. In recent times, it has become very popular to write options in India. A lot of individual investors have been doing this, and some of them are retail investors. A lot of them have burnt their hands in this. It is, like I have said several times, putting if there is a note available in front of an electric train running at 150 kilometers an hour, you go and snatch that money, bundle of note, and come out of it. It is not a cup of tea for 99% of people, including me. This is indeed, like Buffett says, a weapon of mass destruction. And why have I not done it? Because I don't believe or I don't have the time or the bandwidth to sit in front of the in screen the whole day because I simply don't have the time. One has to sit in front of the screen and see the movement and understand macroeconomic trends to make a bet. The other disadvantage of doing options in India is only the near month option is active. So you have to take a guess what's going to happen in the next 30 days. And there are some indices like the banking index, which settlement happens every week. So it's very difficult and it requires great skill to do it. And why am I out of the blue talking about it today? Is because the man sitting next to me is clearly an option trader who's been trading in options for the last 3 years. He has had his ups and downs, some bad months and some great months, but overall he's been very profitable. So I wanted to discuss option trading with him. Dilip, what is option writing first?
Option writing is like issuing an insurance policy. So when you issue an insurance policy, you get a premium, like insurance company.
Okay,
So when you write an option, you get a premium.
okay.
Okay, but you are bearing that risk
Hmm.
of that insurance claim coming through.
It's like writing a car insurance.
Yes,
If there is a car, you write, you get the premium.
yes,
You get to enjoy the money for 1 year.
yes.
If the car meets another with an accident, you pay the claim.
You pay the claim.
Yeah. So now come back to option writing and tell me how it works. What
So
is a call option? What is a put option?
okay, a put option is you take a position or write an option uh, that the stock will be above a certain strike price, right? And if the stock stays above that price, you get to keep the premium you get. Okay, so more aggressive the position, more closer to the market rate,
Hmm.
higher the premium. higher the risk,
Hmm.
right? The call option is you take a position higher than the market rate,
Okay.
expecting it not to breach it.
So
So,
you take a position. Suppose Tata Steel is at 115.
yeah,
You say it won't go beyond 125 this month.
correct.
That if you don't expect it to go,
Yes,
and you, to be safer, you want to say at one it will not cross 135.
yes,
But at 125, you will get a higher premium.
yes. As you move away,
You will get lesser and lesser,
lesser and lesser premium,
premium. So nearer to the current market price, you will get more
higher
premium,
premium.
and more away from the market, you will get a lower premium.
Plus,
Okay,
more the volatility, the premiums tend to be higher.
higher. Okay, this is one. What is the put option?
So, put option is you take a position less than the market rate,
Okay,
right? So, you expect the price to stay above the position you take,
okay.
right? Call option is you expect the price
Price
to
to be
be
lower than what you
lower than
take.
the position you take.
So a put option is an exact opposite of a call option.
Yes,
So if I say I take a put option of Tata Steel at 130,
yep,
then I expect the price to be lower, much higher than 130.
yes,
So if anything less than 130, I lose money.
yes,
If it's 130 and above, I make money.
yes,
So I get the premium.
yes,
So option writers are people who basically write options for people who want to buy and buy options.
yes,
So you are a market maker also.
yes,
So you are making market.
yes,
Okay. So basically you are providing liquidity in the market
yes.
and willing to take a
It
small.
acts as another stabilizing
You are a stabilizer in the
layer.
layer. Now in this, I know what you do. Can you explain your hedging strategy in what you do and how do you limit your losses?
Say right now, Tata Steel is at 125.
Mm,
Okay, I expect it to stay above 120.
mm,
So I take the position at 120. Okay, but
mm,
in the scenario it crashes below 120,
mm.
there is no limit to the loss I can incur.
Okay. Suppose
Right?
I wrote call options. Let's understand from a call option.
Yeah,
The current price is 120.
yeah,
I have written a premium, written a call option at 135, thinking it won't cross 135.
yeah,
But having crossed 135, it can go to any amount.
yeah.
It is
Suppose
sky is there. It can go to 1,000 rupees
it
also.
can, yeah, the extent you can lose can be enormous,
Unlimited loss.
unlimited loss.
The loss is limited. The money you have got is only premium.
Correct.
Like if you with a 25,000 car premium, you can have a total wreck. Like if you had a storm and the entire vehicle is condemned, you have to pay for that vehicle
Correct.
for the full insured value.
Yes.
So similarly, if you write at 135, it goes to 250. So you will have to pay 135, 115 rupees per share per lot.
Per lot. Yes.
So that's an unacceptable loss.
Yes.
So what do you do?
So when I take a position at 135, uh, I take a contradictory contraposition at say 140 or 150. Uh, so by doing that, you cap the losses in case the share price runs off.
Sorry. So you have an opposite. You would have sold an option.
You sell an option say 135
Hmm.
and buy an option say 145.
So you would have
Okay.
bought it at 145.
So
So as long as even if it's between 135 and 145,
yeah,
you are not a loser.
yeah, maximum even if it goes above 145, maximum you lose
Loses
10
that
rupees per share.
you will lose 10 rupees. So what you are saying is you are defining the loss when you get into this game.
Yep.
So when I said weapon of mass destruction, when I call it weapon of mass destruction, I said the losses can be magnified, the profits can be magnified. Whereas the strategy you have developed is your profit is also defined, your loss is also defined. You don't make, if it closes below, you get the net premium in your case.
Yes.
There is the premium you pay,
And premium you
what is
get
the
and premium you pay.
pay.
The difference you
The
get.
difference is your money.
Yes.
But if it goes out of your control also, your loss is limited to the 10 rupee per share per lot.
Yes.
So basically, you say the idea of you getting into trading is you define the loss first
Yes.
and you never keep it unhedged unless You are very sure.
Very rare, very rare.
Very,
Unless you're very sure and you take really off, no,
but it is very possible to, why it's very rare is you don't get a 12-month option or a 9-month option in India.
correct.
Though it's technically there, it's you cannot do it.
Yes,
So what you are doing is you are trading only the next 30 days.
yes,
And since you are only trading in the next 30 days, a lot of extraneous incidents can affect the price.
yes.
Like suppose you are trading in steel.
You can trade beyond even 30 days, but the liquidity will be
At the
very low.
time saying liquidity,
Yeah,
it's not there.
not there.
So suppose you are trading in Tata Steel or JSW. Nirmala Sitaraman one fine day announcing that exports will be banned is a news that you won't expect,
Correct.
but will affect your future, it will affect your options.
Yep.
So the idea of hedging is because you are doing very small trades in times of period, time period is small. A news item, a news link, an unexpected news source can sink your stock.
Yes,
Therefore, you want to hedge it. Am I
yes,
right?
yes. That's right.
Like imposing windfall tax or imposing an export duty on a steel
Yep.
can sink your stock if you're on Tata Steel or on JSW.
Yes,
Putting out a windfall tax will affect Reliance,
yes,
and you cannot second guess it
yes.
unless you have prior
Yeah.
information.
Anything what affects the market affects the
Yeah.
premiums and the.
So, and since even though the effect is transient, because your premium amount is next 30 days, transient factors take a bigger importance.
Yep.
So, the whole idea of hedging is to negate that
Negate
transient
that.
factor.
Yeah, you don't have control what happens in next 2 3
Yeah,
weeks.
yeah.
And
So, the fundamental difference between trading and investment is when I look at investment, I take a long term view of the market.
yep.
So, when I buy Tata Steel, I know I can keep it for 20 years. I don't worry about whether Nirmala Sitaraman decides to ban exports today. In fact, I will use it as an opportunity to buy more.
Yep.
But as a trader, what happens is that can make you or sink you,
Yes.
depending on whether you are long or
The
short.
fundamentals also play a role,
Role.
but all this yeah, temporary or the transient
The transient factors play a bigger.
factors can play a very big
No,
role.
no, I'm saying the
Yes.
odd news, random event
Yes.
can sink you.
Yes.
Like the Russian Ukraine war could have been a nasty surprise.
Yes.
So the temporary factors have a bigger bearing on the price of a option than the fundamentals because you have only a 30-day option.
Yep.
Whereas if you had a 120-day option, fundamentals will play a bigger role.
Yes.
So, but for 360-day option is available in the rest of the world, there is liquidity. In the Indian market today, there is no liquidity. Am
Yes.
I right?
Yes.
So the people who buy from you are the normally the institutions will buy it.
Institutional. Yeah.
They will need the option, so they will be.
Institutionals dominate this segment. Yeah.
So this institutions dominate this segment. Now, do you? I know you don't use leverage at all. In that, both of us are in sync. So you keep money. How much cash is minimum you need to keep?
At least about 10 to 15 lakhs is required to have some spread and just de-risk and have
So if you
few
have
few
15
different
lakhs in
positions.
your hand,
Yes.
and if you have 2 3 positions which are hedged, you will not take a big hit.
Yes.
So you may have 3 bad months in a row where may lose some money, say about 15 20
Yeah,
percent
as
of it.
long as you hedge, you
Yeah,
can
I'm saying with hedge,
it will give some time to recover.
but it will give you will maximum lose 10% of your portfolio over 3 bad months,
Yes.
whereas you can make it up in the next 6 months.
Yes.
So basically, your tenant is no leverage.
Yes. Leverage is too risky.
So what you do
Uh,
is whatever is the premium for writing the premium to cover the margin requirement, you keep it as cash.
yes.
So even there's a bigger swing, you can absorb the cash.
Yes. And you
Whereas,
always keep a buffer about 25% of the total invested margin to take care of the fluctuations.
fluctuations. So if you have a 10 lakhs, if you have paid 10 lakhs as your margin,
At least two and a
and
half,
at
three
least
lakhs,
3 lakhs you will have,
always keep it as cash.
keep it as cash so that you can pump it in to keep your position alive. So, boss, there are 2 3 things you guys should understand. He is not treating it as a weapon of mass destruction. because he is hedging. So he defines his loss in the first place. Correct?
Yes.
Second, what he does, no leverage. So he has an extra 3 4 lakh apart from the 10 lakh margin which he has paid. He will have 3 4 lakhs which he can inject to keep the market at play, even if the trade goes against you in the short run. Correct?
Yep.
Three, you don't take leverage from an NBFC or from a broker because it will destroy you, because you need much more money in backup.
Yep.
Most traders fail because they take leverage. They don't have 10 lakhs, they have no business to trade. Second, they borrow that 10 lakhs, so they have to pay interest. Third, having invested 10 lakhs, they leverage to take 40 lakh positions, which means a small swing against them can wipe them clean.
Yes.
So these are the points. Don't take leverage, keep a separate float of cash only to do this, and for 30 to 40% keep a
Buffer.
buffer, and don't do more than 2 3 trades in a month. I think you do 5 trades or 6 trades in a month.
Yeah, about 7 8 trades, and don't take all positions in like
And
on
the
one day or
one day,
within 2 3 days.
no,
Spread
spread
as
it
much
out.
as possible. Yeah.
So you spread it and you are not under pressure.
Yep.
The idea is use your money to trade. Don't take money from the company. Second, be very clear, hedge it so you can define your loss. Most of us get out because we keep on pouring money from our pocket. We don't limit the amount of capital required and see how much profits you are generating. And being too greedy, we hedge with the we leverage with the broker's money, which wipes you clean. So these are the rules. I don't trade, but I can vouch for a fact he successfully trades. This is because, like I invest in stocks and I'm not greedy, so I don't put on leverage. He is surviving because only the option is a leverage. He is not leveraging to trade with more options. That is, if we can write 6 to 7 options without leverage. The same thing, by using leverage, he can write 50 60 options, but a minor wave against him will wipe him clean. So these are the matters which precautions you need to take before getting into trading on options. It remains, if you use leverage, a weapon of mass destruction. Am I
Yes.
right?
Yes.
Thank you for watching Be Rich. If you like
Thank
this
you.
content, kindly subscribe to our channel and turn on the bell notification. If you have already subscribed to my channel, please send this video to your friends and relatives and ask them to subscribe to our channel. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.